The Vanguard Real Estate ETF is the biggest REIT ETF in the world, and today it only offers a 4% dividend yield. That's rather disappointing when you consider that money market funds today offer closer to a 5% interest rate, and leaves many people thinking that REITs today are overvalued. But this isn't true. REIT valuations are today at their lowest level since the great financial crisis, and their dividend yields are also historically high. However, this ETF in particular is offering a low yield because of three key reasons. Firstly, it's mostly investing in growth REITs such as those that own data centers, e-commerce warehouses, cell towers, and so on. Then secondly, it's market cap weighted, which means that most of its capital is going towards mega cap REITs, which typically trade at higher valuations. They have investment grade rated balance sheets because they use little leverage, and they also typically maintain very low dividend payout ratios. And then the third and very important reason is that this is not a REIT exclusive ETF, it's a real estate ETF, and so it also invests in non-REIT companies like home builders and brokers, which would typically don't pay any dividend. So with that in mind, the Vanguard Real Estate ETF, ticker symbol VNQ, actually isn't representative of your average REIT, and as you will see in today's video, there are a lot of attractive REIT investment opportunities that offer dividend yields in excess of 8% at the moment. Hey everyone, this is Jussi. I run a small investment firm that specializes in REIT investing, and today's video I'm going to talk to you about my 3 favorite high-yielding REITs to buy at the moment. Before I get into it, can you please do me a huge favor and click the like button? That helps me a lot to grow this channel. Thank you so much in advance. So the first REIT I'm going to talk about here is called New Lake Capital Partners, ticker symbol NLCP. This is a small cap REIT that specializes in cannabis cultivation facilities, and is today offering an 8% dividend yield. This high yield would seem to suggest that the company is facing headwinds, that it's over-leveraged, and that it's at risk of cutting its dividend. But none of this is true. New Lake actually has some of the best growth prospects of any REITs in today's market. It also has zero debt, which is quite unique for a REIT, and it's also sitting on a very large cash position. And finally, its dividend payout ratio is very conservative at 82% for a REIT with zero debt, and that's focusing on net lease properties. And this is well reflected in the company's track record, as it has managed to hike its dividend in nearly every quarter since going public. And I just think that this strong growth is set to continue in the coming years because of 3 key reasons. Firstly, it has very long leases with over 10 years left on them, and they include annual rent escalations of nearly 3%. Its tenant are also responsible for all property expenses, including even the maintenance of the property, and therefore these 3% rent hikes really fall down straight to the bottom line. Then the REIT also has 25 million of cash, and it has access to a credit facility of an additional 90 million at a 5.75% interest rate that's locked until 2027. That's very significant for a small REIT with a $400 million market cap, and could invest all of this capital into new properties at cap rates in excess of 12%, resulting in very large spread over its cost of capital. Finally, the REIT also retains about 20% of its cash flow to keep acquiring new properties and also fund buybacks at a discount to its net asset value. So in this particular case, the high yield is not the result of high risk or poor growth prospects. We think it's simply the result of a low valuation, with the stock today trading at just 10 times FFO. My expectation is that as New Lake starts to deploy this capital into new properties and its growth accelerate, we will then see its FFO multiple expand closer to 13 times FFO or 14 times FFO, and that alone would unlock about 30 to 40% upside, and while you wait, you're earning an 8% dividend yield and the company keeps on growing. The dividend was hiked already once in 2024, and I suspect that they will hike it a second time also later this year. I think that this is very attractive, especially coming from a REIT with zero debt in today's rising interest rate environment, and for this reason New Lake is a big position in our core portfolio at High Yield Landlord. By the way, if you want to access our entire portfolio, you can join us for a 2-week free trial. I'll put a link to it in the description of this video. Then the second REIT I'm going to discuss here is called EPR Properties, ticker symbol EPR. I think that it's also one of the best high-yielding opportunities to buy today. This is a net lease REIT, just like Realty Income or NNN REIT or Agri Realty, Essential Properties Realty Trust. These are all very popular REITs. EPR is different from these other net lease REITs in that it focuses on experiential properties such as movie theaters, golf complexes, ski resorts, water parks, amusement parks, hot springs, and so on. And today it's priced at an 8.3% dividend yield. This is the highest yield in its entire sector. Again, this high yield would seem to suggest that EPR has poor growth prospects and that its dividend is at risk of being cut, but once more, this is not true. Its dividend payout ratio is actually one of the lowest in its history at just around 70%, and just recently the REIT hiked its dividend by another 3%, and it has guided for strong growth to continue. So again, here I don't think that the high yield is the result of high risk or poor growth. It's rather because the stock of the company is heavily discounted, just like in the case of New Lake Capital Partners. EPR is actually even cheaper than New Lake at the moment. So again, here I don't think that the high yield is the result of high risk or poor growth prospects. Rather, I think that the high yield is the result of a low valuation because the share price of the company has crashed in the past years. It's today heavily discounted, and as a result, it now offers a high yield. So why is it cheap today? The market appears to worry about EPR because it thinks that these experiential properties could suffer in a coming recession. But what the market appears to ignore here is that EPR is a triple net lease landlord that's earning steady rental income from long-term leases with predefined annual rent hikes. Today's lease is over 10 years long with 2% annual rent hikes on average. EPR is not the operator of the properties, it's simply the landlord. Then secondly, even if its tenants suffer temporarily in a recession, they will be very unlikely to default on their leases because these properties are absolutely essential for them to operate their businesses. Then thirdly, today EPR enjoys historically high rent coverage ratios of 2.2 times on average. And what this means is that if we went into a recession and the profitability of its tenants dropped somewhat, they will still be able to cover their rent in most cases, because if you're able to cover your rent by 2.2 times profits, even if your profits get cut in half, you should still remain profitable and be able to pay your rent. And then the fourth important thing to consider is that most of these experiential categories on which EPR focuses is actually quite recession resistant, because these are relatively affordable forms of entertainment. Just think about movie theaters as an example, or going to the water park. Typically in a recession, people will cut down on the very big expenses. Perhaps a family will skip their annual trip to Europe, but instead they will still go to their local water park to entertain their kids. This year, EPR has guided to grow its FFO per share by another 4%, and it has noted on previous earnings call that it should be able to maintain this pace of growth even without having to access the external capital markets. And the great thing here is that because the company is priced at such a low valuation and such a high yield, that's really all that's needed to reach strong double-digit total returns. If you simply add the 8.3% dividend yield with the 4% annual growth rate, you get to roughly 12% average annual total returns. And then on top of that, as EPR keeps proving the market wrong, it keeps strengthening its portfolio, and as interest rates return to lower levels, I would expect its FFO multiple to expand back closer to its historic range, perhaps closer to 12 times FFO, and that alone would unlock another 40% upside from here. So between the upside, the high yield, the steady growth, I think that the return prospects for EPR are really strong, and this is an investment grade rated REIT with an exceptional track record. It owns defensive properties, in my opinion, much more defensive than what the market gives them credit for, and therefore I think that this is one of the best risk to reward in today's marketplace. And then the third REIT I want to discuss is called Armada Hoffler Properties, ticker symbol AHH. This is a small cap diversified REIT that owns mostly service-oriented strip centers, apartment communities, as well as some office buildings, and is today priced at a dividend yield of nearly 8%. And once more here, that's despite having a low payout ratio of just 75% and also just recently hiking its dividend by another 5%. That's not typical of a REIT that's about to cut its dividend, and if you listen to the previous earnings call of the company, you'll see that the management is actually very optimistic about their future, and this explains why they've kept hiking their dividend. So just like in the case of New Lake and EPR properties, I don't think that the high yield here is the result of high risk or poor growth. It's again because the valuation of REITs are today at a decade low level, and this is resulting in very high yields. So why is Armada Hoffler so cheap despite performing well? I think that there are three key reasons. The first one is that this is a diversified REIT, and the market typically does not like REITs that lack specialization because you cannot be a jack of all trades, and so it tends to punish diversified REITs with a lower valuation multiple. Typically, I would agree that taking a diversified approach makes little sense because REIT investors can themselves take care of the diversification across different property sectors by owning different REITs. But in the case of Armada Hoffler, I think that makes sense because it focuses on a very small geographic region and it's a real estate developer in those markets. Secondly, this is a fairly small REIT, and today the smaller and lesser known REITs trade at much lower valuation multiples than their larger peers. And then the third and final reason is that Armada Hoffler also generates about 30% of its revenue from office buildings, and this property sector is today hated by most investors, and as a result, a lot of investors will not buy Armada Hoffler because of this reason alone. I also dislike office buildings, and I fear that it will suffer significant headwinds in the coming years as we transition to the hybrid work environment, but I think that in the case of Armada Hoffler, these fears are a bit overblown. Firstly, about 70% of its revenue comes from service-oriented retail strip centers and apartment communities, which are doing really well, and so this compensates for any potential weakness coming from its office division. And secondly, and perhaps even more importantly here, it's important to recognize that not all office buildings are created equal. In the case of Armada Hoffler, it really owns the best of the best properties. These are Class A new build modern properties that are in mixed use destinations that are typically walkable, and this is really the type of office buildings that are still thriving today. Moreover, most of its office buildings are also under long-term leases, and that should provide good protection even as we go through this difficult cycle of oversupply. Therefore, I think that the low valuation is here unwarranted. Most of its assets are very desirable, they enjoy very attractive long-term growth prospects, and despite taking a diversified approach, which typically isn't appreciated, well, in the case of Armada Hoffler, it has actually worked pretty well. The company has managed to massively outperform the Vanguard Real Estate ETF since going public. Just like EPRA, I expect Armada Hoffler to eventually reprice at closer to 12 times FFO. It will still be priced at a large discount relative to most REIT, but even then, that will still unlock about 40% upside from here. What's the catalyst? I think it's pretty simple here. As the REIT keeps increasing its exposure to multifamily assets, I think that eventually the market will reprice it as a quasi apartment REIT, and on top of that, as interest rates return to lower levels, that should boost the demand for the stock. And while you wait, you get paid generously with a near 8% dividend yield, and the REIT will also keep on growing in the coming years. I discussed just 3 high-yielding REITs in this video, but there are many more. We specialize in exactly this type of REIT investment opportunities at High Yield Landlord, and we currently own 23 REITs in our core portfolio. And you can access it completely for free with our 2-week free trial. I'll put a link to it in the description of this video in case you want to access my entire real money REIT portfolio. If you thought that this content was valuable, please click the like button and also subscribe. That will help me a lot to grow this channel. Thank you so much in advance, and see you at my next one. Bye bye.